Most crypto assets are not themselves securities. That's what the SEC chairman said this week on the record. So if you hold Solana, XRP, Cardano, or other crypto, your regulatory risk has just dramatically reduced. So if you bought like Solana at any price at any time, your legal cloud is gone. Like not just reduced, it's gone. If you have been told that you are holding unregistered securities, the SEC now disagrees in writing. So if you're building in crypto, this is the new legal architecture that you will live under and the one that the space has fought for years. So if you were debanked, your accounts were closed, if you were told crypto was too risky, the CFTC chairman has just admitted what happened to you. So the quote is, "We have seen major financial institutions debank companies and individuals who did nothing more than operate within a politically disfavored industry." So the regulators have just confessed they have specifically disfavored crypto, and now they are racing to fix it. My name is Dariia, I'm the co-founder of EternaX Labs. This is the Control Loop, and today with me we have Mansi, Crypto Practice Lead, and Paarrthhh, my co-founder. So Mansi, can you clarify with us what exactly dropped this week?
The SEC and the CFTC jointly released their final interpretive rule. It's called the application of federal securities laws to certain types of crypto assets and certain transactions involving crypto assets. The letter is as long as the name. It's 68 pages. Both agencies have signed on. This is not guidance. This is not a staff letter. This is binding interpretive rule. And SEC Chairman Paul Atkins said something that I have never seen a federal regulator say, which is that for over a decade, market participants have operated without clear guidance on a fundamental question: when does crypto assets implicate federal securities laws? Today, I'm pleased to announce that the SEC's persistent failure to provide clarity on this question is over.
Wait, so did he really say that they have failed before, like to describe his own agency?
In writing, he's used the word failure for the first time in the time that I have been involved with federal regulators. It's been published on sec.gov. The actual term verbatim is persistent failure. His words: "In my career, I have never seen a federal agency admit its own failure in a published document and then reverse course in the same release. This does not happen. I mean, of course, until now."
Well, then we still have to be happy that they did change their course.
Yeah.
So kudos for admitting it. I have heard that they have like specifically named certain assets that had been in a like disputed gray area. Could you list maybe what those were?
So there are actually 16 assets that are now explicitly named as digital commodities. It includes Bitcoin, Ether, Solana, XRP, Cardano, Avalanche, Polkadot, Chainlink, Litecoin, Stellar, Tezos, Dogecoin, Shiba Inu, Bitcoin Cash, Hedera, and Aptos. We like to be pretty exhaustive here. Algorand and library credits are named in a footnote. The combined market cap of all these tokens is $2.8 trillion, and that is more than the market cap of every bank in America combined, just so we can imagine the scale.
What does this like practically change anything for people who already hold these assets from previously?
Yeah. So there's actually three things if you as an investor own these tokens. Three things change for you. The first is the SEC cannot sue you for holding an unregistered security. That legal theory is practically dead for these assets. Second, every person who told you you are holding an unregistered security was wrong, and you get to tell them, "I told you so." And the SEC now disagrees with them as well. In writing, you can send them this document. The third one, the institutions that were blocked from buying pension funds, endowments, sovereign wealth, or your 401k provider now have explicit regulatory cover to allocate. The regulatory uncertainty excuse is now practically dead, and demand will unlock.
Right, so I guess if you hold Solana, XRP, or Cardano, any of those things, you can just send this episode to everybody who told you it was a security. I'm gonna do this. Absolutely, they need to see this because it's a big deal. I know that like Ripple specifically has gone through a very long legal battle over like 4 years of litigation with government. So like what happens now in that case?
So SEC versus Ripple is functionally over. The SEC sued Ripple in December 2020, 4 years, hundreds of millions in legal fees. The SEC demanded $2 billion in penalties. Now, XRP is explicitly listed in this rule as a digital commodity and not a security. The same agency that spent 4 years trying to prove XRP was a security just published a binding interpretive rule saying that it is not.
So I guess XRP came out the winner out of it, but the biggest winner were probably the lawyers who took in all the legal fees. So what for people who have held XRP through all of that then?
You won. You were right. The SEC was wrong, and they've admitted it now.
Well, let's also though thank you, Mansi, for that clarification. I think the industry is pretty happy. But let's also ask Paarrthhh, like before we get deeper into like the legal framework, let's talk about like what's happening like behind the scenes. This rule doesn't just like exist like in a vacuum on itself. It lands at this specific moment with like all the other regulatory stuff happening, and there is a banking war with Coinbase. Is it coming to an end? Is it the chokehold?
Yeah, Dariia, for 4 years, the federal regulators, they ran a covert campaign to cut crypto off from the American banking system. They used the concept called reputation risk. If a bank, served crypto companies, examiners would flag it as a high risk, high premiums, lower capital ratios, restrictions on the other business lines. Banks got the message clear back then that they started closing accounts and no explanations, no appeals, no recourse. The industry called it Operation Chokepoint 2.0, and the regulator denied it ever existed. They said it was a conspiracy theory. And then in December 2025, the OCC reviewed the 9 largest national banks of America. The finding is, and you'll find this surprising, is that all of them had engaged in discriminatory debanking of lawful crypto businesses. And yesterday, CFTC's chairman Mike Selig said it publicly. And I'll quote him. We have seen major financial institutions debank companies and individuals who did nothing more than operate within politically disfavored industry.
Yeah, like I am so surprised that the CFTC chairman literally confirmed it on the record.
On the record, Dariia, it's on the record in his official capacity, and what industry alleged for 4 years was just validated by the head of federal agency.
And also, like JPMorgan's been a big part of that doing to people in debunking the companies. That was infuriating for years.
Definitely, Dariia. I think JPMorgan is one of the serious players, and you can call a villain for that matter in this story. In February 2021, JPMorgan closed more than 50 Trump-related accounts. In November 2025, they closed all accounts belonging to Jack Millers, the CEO of Strike, one of the most prominent Bitcoin payment companies. No explanation, no warning, just logged out. Jamie Dimon spent a decade calling Bitcoin a fraud, a pet rock, a Ponzi scheme. In December 2025, while the OCC was confirming that his bank had illegally debanked crypto companies, Dimon was on Capitol Hill lobbying the Senate against the stablecoin legislation, that is the Genius Act. And then, after all of that, JP Morgan announced that they are launching crypto trading for institutional clients in December 2025. They launched a tokenized money market fund on Ethereum with $100 million in initial capital.
Wait a second. It's the same Jamie Dimon who's been calling Bitcoin a fraud is now also launching his own crypto products. Did I hear that right?
Definitely, Dariia, the same one. The same Jamie Dimon spent a decade calling Bitcoin a fraud. His bank spent 4 years debanking crypto founders, and now that's the rule changed and he wants a cut. So that is not a strategy. I think that is extortion with a suit and a tie.
I mean, I can imagine the JP Morgan ex-clients who were debanked would be pretty furious at the moment, but at least their future is clearer now. So if you were debanked because you're holding crypto or your company, if your accounts were closed and you're watching these institutions attack you and the industry and your own business for like more than 40 years, you literally have to share it. They need to be held accountable for what they done. We cannot just like cross it off the books now. So let's get back to Mansi, like back to the rules and this attachment-detachment framework. I didn't really understand what that was about. Can you explain that part that basically changes everything for tokens going forward?
Right. This is actually the most important concept in the entire rule. And it's actually simple once you do understand it. What the SEC is saying is that the token itself is not a security. The promises around the token can create an investment contract. A non security token becomes attached to an investment contract when the issuer sells it with representations or promises to undertake essential managerial efforts from which buyers reasonably expect profits. The rule states that an investment contract ends when, quote, either the issue has fulfilled its representations or promises, or the issuer has failed to satisfy its representations or promises.
So can you like maybe practically clarify what it means like for me as a founder? Like what does it mean? What makes my token attached to this investment contract?
So if your white paper, your website, your founder podcast, your official Twitter says, we will build the core features later, or that we will hit roadmap milestones, we will grow the network, token holders will benefit from our execution, then you have created an investment contract. So if you make any forward-looking statements about the growth of the network, the token is attached to your promises.
Should it be detached, or if then how?
Okay. So there are actually two parts. So the first one is fulfill your promises, complete the roadmap, deliver the functionality, open source the code, publicly disclose completion, and the promises are satisfied. That is when the token detaches. The second one is abandon your promises, publicly announce that you are not completing the roadmap, the promises are dead, the token detaches. Of course, then in that case, the project is dead too. Either way, once detached, secondary market sales are not securities transactions.
But does detachment like of the token from this investment contract promises erase the liability of those promises?
That is a good question. It actually does not. And this is very critical for every founder listening. Separation is not forgiveness. It is status change. If you have violated securities laws during the attachment period, you are still liable. Detachment changes current status. It does not pardon the past conduct.
So it sounds like this changes like the whole compliance path. All of these token launches have been going through for years, and these companies have been doing this as a service and so on. So like what is the correct path like from now going forward? And is it already in action?
So there are actually 4 parts. The first one being launch after utility exists, build first, achieve functionality, then distribute the token when there are no promises left to fulfill. It detaches immediately. The second option is launch as a pure collectible. Meme coins with no roadmap, no promises. The rule explicitly blesses this category. The third one is launch as a compliant security. Register under the Securities Act. Use Regulation D or any of the exemptions. Accept the compliance burden. And option 4, retroactive airdrop. Let users interact with your protocol for months, announce nothing, then surprise airdrop based on historical activity. They did not bargain for it, so safe harbor rules apply.
That's insane that they have basically legalized the meme coins with this. So like the era that everybody's been doing, launching this super long white papers promising they're going to take over the world and selling the roadmap to justify the token later is gone.
It's dead. Your code matters, but your promises matter just as much.
Well, it sounds that like for anybody who's launching tokens or planning to ever do one, you are thinking to do it in US, you have to revisit whatever your legal strategy was, because the playbook just changed under our feet. It became better, but it's changed. Let's do like some rapid fire statements. So does this change anything on staking?
Not securities. The SEC explicitly says that its jurisdiction does not include protocol staking and protocol mining. All forms are blessed.
Okay, so what about liquid staking tokens like staked ETH, RETH? That's still $35 billion.
Not securities again, if the underlying is not security. Ether is a digital commodity, so any liquid staking tokens based on Ethereum is a receipt for Ether.
So is it still the same for like wrapped Bitcoin that's still $12 billion market cap?
Yeah, not a security, one-to-one backed, no hypothecation. It's absolutely clear.
Okay, but what about airdrops?
So pure airdrops with zero considerations are A-okay. Retroactive airdrops based on historical activity are the compliant path.
Okay, so that's pretty clear about all of the things. What's like not clear still?
So there's restaking, DeFi protocol liability, long tail of unnamed tokens, and cross-border implications. But Chairman Atkins told reporters yesterday, quote, "Hold on to your seats." He said there's a 400 plus page formal rulemaking, which is coming in a week or two with an innovation exemption for crypto firms. The gaps will fill, but the architecture is largely set.
Cool. So then I guess we're going to have to wait for those gaps to fill, and we're going to have Mansi back to explain them to us. Let's go then to Paarrthhh. What does this mean to like market effects, like first order?
So the legal uncertainty just got repriced, Dariia, and the legal uncertainty is not a side variable in crypto. It is the variable right now, and it affects everything: listings, market makers, derivatives, institutional allocations, custody, and everything. CFTC Chairman Selig has put it very simply, and I'll quote him, is that I think the signal is clear now that it's time to build in the United States. That is the head of federal agency telling the world America is open for crypto business.
The banks have like spent years on fighting crypto, so do they practically change their stand now?
They are in fact changing their stance right now, Dariia, as we are speaking. They're racing to get in, every single one of them. Citibank launching crypto custody in 2026. They have been building for 3 years. Morgan Stanley offering crypto trading through e-trades in H1 2026. Charles Schwab, $11.6 trillion in asset, is launching Bitcoin trading in H1 2026. Their CEO said 20% of the Schwab clients clearly own cryptos outside the platform, and they are coming to get their business. Bank of America authorized 15,000 Merrill advisors to recommend Bitcoin ETFs starting in January 2026. JPMorgan, after everything they did, is building institutional crypto trading and launched a tokenized money market fund on Ethereum. The same institution that built the wall are now racing to tear it down.
I guess when the question comes to money, the stance can change very quickly. But what about the products that are built on top of these rails? Not just the coins themselves, but things like DEXs and like specifically perpetual futures. That has been the big unlock for the market. What changes for it?
Yeah, Dariia, definitely. I think perpetuals is something which everybody wants to hear about. So global perpetual markets right now trade somewhere around $75 to $100 billion on daily notional volumes. And this is more daily volume than NYSE. And Americans have been locked out until now. And if underlying asset is a security, the perp is SEC jurisdiction, no workable framework. But if the underlying asset is a commodity, the perp is CFTC jurisdiction, clear framework, and decades of precedence. So 14 assets just got classified as digital commodities, and the CFT signed on, and the chairman Selig confirmed it is coming, and he said his agency is close to coming out with policies around allowing crypto perpetual futures. I will repeat this again, and this is very, very important for all the projects building out there. He has said that it is close to coming out with policies allowing crypto perpetual futures within 2 weeks from now. So crypto perpetual futures have largely developed offshores because of US reluctance to pursue industry regulations. This reluctance is now over, Dariia.
So does this naming of specific assets and specific things change the market structure?
Definitely, Dariia. The perps market becomes barbelled. Very deep liquidity in the named digital commodities: Bitcoin, Ether, Solana, XRP, Cardano, Avalanche. Hard ceilings on ambiguous long tail names. If the underlier has unresolved legal status, risk committee says no. Exchanges now have to underwrite. They now have to underwrite time and not just tokens.
Okay, then let's get into the other area of like DeFi. It has always been like sort of gray with like, again, all the meme coins and all the stuff that's happening there. Is it clear? Are there winners? Are there losers? Is it dead?
So DeFi, Dariia, is not dead. Does not die. It basically becomes professionalized. So winners are infrastructure protocols like us, like EternaX, staking flows, liquid staking on clean underliners, one-to-one wrappers, payment stablecoin rails, collateral system on legally clear assets. Why? Because legal clarity improves collateral confidence, and collateral confidence improves composability, and composability improves capital efficiency. So Aave TVL is 25 billion. With institutional capital, it could hit 50 billion within 24 months. So the losers essentially would be securities packaging wearing a crypto mask, yield wrappers with extra claims, governance tokens sold as managerial upside, anything where the token is a bet on a team execution. So Chairman Selig has explicitly said that, and I'll quote him, that put the prior administration's ecosystem theory of security status to bed once and for all.
That sounds like this is finally clarifying and making light for building in the United States and building in America. And this has been claimed of this administration for a while coming. How does this now practically change American positioning in the global market?
Definitely, Dariia, it's like something, America is far ahead. I would say Japan is trying to catch up, but MICA in Europe is 150 pages of complexity. Singapore is, clear but very small. Dubai is welcoming but no capital markets depth. So the United States just published the 68 pages of clarity backed by the deepest capital markets on earth. Both the agencies signed on and joint enforcement coordinating rulemaking. Chairman Selig has said it directly. I believe the United States should serve as the base layer where builders choose to deploy the systems powering the new frontier of finance. So that is, America has won, I would say.
Well, this is certainly a historical moment for this whole industry. It's been fighting for years, and I'm happy that we're building in this moment. So what we can build on top of it actually, Bars?
So 3 layers, Dariia. I think layer 1 is banking integration. So banking, custody, digital commodities lend against them as collateral, offer linked products, and this is like 10x multiplier of the accessible capital. Layer 2 is distribution expansion. So Solana ETF, XRP ETFs, multi-asset crypto index funds, access beyond Bitcoin. Grandmother's financial advisor recommends a diversified crypto fund, and that was impossible 6 months ago, but it is inevitable now. And the layer 3 is, Dariia, the infrastructure maturation, which is where we stand. The assets are clear, the banks are entering, the capital is coming, but the infrastructure that capital will run on, that is still being built on, and that is where, Dariia, we come in as EternaX. So we have built our entire architecture, Dariia, assuming this clarity would come. And so we have built post-quantum settlement, institutional custody with policy control, stablecoin issuance rails, market infrastructure, venues, prediction markets live. Perps is next. So the regulatory question was never if, it was when, and now it is now. It has come. So the builders who position for this moment, we are not pivoting, we are accelerating.
Great. Let's celebrate this with trying to make some bold predictions about how is this going to affect the market within like 12 months, 18 months, and then we can look back at it and see if we were right. So, Paarrthhh, what's your stance?
Definitely, Dariia. So 5 predictions coming from my side. 1, within 18 months, you will custody Bitcoin at JPMorgan, trade Ether through Schwab, and get Solana exposure through the Bank of America Wealth Manager. Prediction number 2, CME launches Solana perps within 12 months and the others follow. Prediction number 3 is like if US venues capture 15% of the global perp volume, that is $11 to $15 billion of daily notional through the regulated American infrastructure, the perps market coming onshore is hundreds of billion dollars of opportunity. 4, by 2028, 60% of the global crypto market infrastructure will run through America regulated rails, up from maybe 20% that is today. 5, Aave TVL doubles from 25 million to 50 billion within 24 hours as institutional capital enters. And that is how confident I am. The architecture is set, the capital is coming.
And none of this is investment advice, of course. This is our own opinion, and we're going to see if we were right. So, for people who are advising, who have been telling your clients to avoid crypto, you need to read this rule. Your fiduciary duty just shifted. For people who have been holding those named assets, you have to check your cost basis because your tax treatment may have just simplified by a lot. For people who have been building and complicating their legal status with foundations and overseas and offshores, the window is now open for you to move and legalize better. And this is truly historic for the industry. So let me summarize and put this in context. This is now the most significant crypto regulatory event basically since Bitcoin came out. I don't think nothing like actually have ever come close. For years, crypto has been facing a two-front war. One on SEC that has been attacking it with enforcement and lawsuits and classification uncertainty. Then the barking regulators who have been attacking the businesses with chokehold, was debanking them, making reputation risk, closing accounts. In this 6 months, they have both collapsed. So this is certainly something to celebrate. So in December 25, OCC has confirmed that banks have illegally been debanking crypto businesses. In February 2026, the Fed has proposed eliminating reputation risk on crypto assets. And this week, SEC and CFTC both together published this interpretive rule in 5 categories in 16 named digital commodities in $3 trillion classified. SEC Chairman Atkins has literally said the SEC's persistent failure to provide clarity on this question is over. And CFTC Chairman Selig has said the signal is clear now that it's time to build in the United States. Atkins also told the reporters, hold on to your seats, more is coming. So for everyone who have held through the lawsuits, through the fear and doubt, through the debunkings, through the years of crypto is dead, we have won. And regulators have admitted they were wrong. The banks are crawling back and the industry is gonna grow. And the people who have believed in this technology when it was hard, we were right. We were right, and crypto is no longer being sorted by narrative, it's being sorted by legal architecture. And the biggest losers are not crypto. The biggest losers, I guess, are the regulators so far here and people who have not believed for years and lost their chance. Thank you everybody for listening to Control Loop. If this episode has changed how you think about your portfolio, your project, or your career, share it with your friends, and people who understand that this framework first will have the advantage. Thank you, Mansi and Paarrthhh, for clarifying the questions, and see you in the next episodes.